Walter Molano, head of research at BCP Securities. Walter has consistently been ranked one of the top Latin American economists by Latin Finance, and he is with us this morning from Stamford, Connecticut. Walter, you have been recommending Argentina for a while. Explain to us how this country went from deadbeat to buy effectively.
Well, the thing is that Argentina was in a very similar situation like Greece. It had a fixed exchange rate in the 1990s in order to get out of its hyperinflation. A lot of investment came into the country, but also a lot of indebtedness. And as a result, the country found itself in a situation of insolvency. In about 2001, it was forced to default. It did a very painful restructuring whereby creditors had to take about a 75% haircut. And as a result, it restructured itself, just like any company. It restructured itself, focused much more on its export side. It's one of the biggest grain producers in the world. We then had the commodity boom, China reincorporating itself into the global economy, and as a result, it's been on a tear ever since, growing every single year since it restructured its debt. Has very good infrastructure, it has very good numbers, and so this is the reason why we've been recommending Argentina for a very long time.
Walter, what are the risks here? Because you have to wonder whether investors' memories are just a little too short. Are they not afraid of getting burned a second time or more than a second time?
Sure. Well, there's always risk in investing in emerging market countries. But the thing is that this is post-restructuring. The country's balance sheet is much better. It has a commitment to return to the capital markets. In fact, it reopened its exchange, and the participation rate was very high. And so as a result, I think that Argentina is on a new track. And it's evidenced by the market. The Argentine bonds have been the best performing assets in the world during the last month or so.
Well, it's remarkable, but let's talk about Greece. What lessons lie herein for Greece? Because what's good for Greece, or at least the ability to come back to the capital markets, isn't necessarily good for creditors. Argentine creditors just got 24 cents on the dollar.
Well, I think that the Greek creditors are going to get even less, because when you take a look at the levels of debt that Greece has compared to Argentina, pre-restructuring, they're much higher. Argentina pre-restructuring, if I remember right, was about 65% debt to GDP. Greece is approaching 140% debt to GDP. And Greece, like Argentina, has a pegged exchange rate. The euro is just another form of a pegged exchange rate. And so it lacks competitiveness. Greece will have to eventually, I think, leave the euro. And then, therefore, it's going to have to do a very large devaluation. When it does that, then the amount of haircut that's going to be needed to put it back into a state of solvency, to put it on a much more sustainable path, is going to be much higher. So, therefore, the Greeks are going to have to are going to have to impose a really severe haircut.
Walter? So I'm afraid we have to cut it off there.